This video is 100% educational. We're not financial advisors, legal advisors, or your uncle who knows a guy. Everything discussed is for awareness, crime prevention, and your entertainment. Don't be Franklin. Imagine waking up tomorrow with 40 million US dollars in cash sitting in your room. No explanation, no paperwork. Just stacks of money quietly judging your life choices. That sounds great for about 5 seconds until you realize you can't actually use any of it. You can't deposit it without raising alarms, you can't spend it without questions, and the moment you try to explain it, you're in a conversation you absolutely do not want to be in. So now you have a new problem. Not how to make money, but how to make money look like it was never a problem in the first place. That problem has a name. It's called money laundering. We'll understand the entire reason why money laundering exists, and we will walk through the whole thing. The 3-stage process, the front business, the shell companies, the offshore accounts, the crypto experiment that didn't go quite as planned, all of it. Think of this as your complete, deeply uncomfortable, totally educational tour of one of the most sophisticated financial crimes in history. Before we get into the front business and the offshore rabbit holes, we need to understand the basic structure of how this actually works, because it follows the same logic every time. Think about it like washing a shirt that's been through something terrible. You put it in the machine, it spins around for a while, and then it comes out the other side looking like nothing happened. Money laundering is exactly that process, just applied to cash, and it has 3 stages with names that make it sound almost corporate boardroom gibberish: placement, layering, and integration. To make this concrete, let's follow a fictional character. We'll call him Franklin, who lives in Los Santos. Franklin has just made $30 million selling what we'll diplomatically describe as premium agricultural products. The money is real, but the story behind it isn't, and that gap is his entire problem. The first stage is called placement, and it's the most dangerous moment for anyone trying to do this, because you're sitting on a pile of physical cash that can't explain itself. The goal is simple: get that cash into the legitimate banking system without triggering every alarm in the building. Franklin's preferred method is something called smurfing, which has nothing to do with small blue cartoon characters, though the whole thing is about as cartoonish. He recruits 50 people, couriers, runners, ordinary-looking people with suitcases, and sends each one of them to a different bank on a different day to deposit exactly $9,900 into separate accounts. The reason for that specific number is that in most countries, any cash deposit at or above $10,000 triggers an automatic report to financial regulators. By staying just under that line, Franklin thinks he's being clever. The government's view on this is that if you're being that careful to stay just below the threshold, you've already told them everything they need to know. Deliberately structuring deposits to avoid that reporting requirement is itself a federal crime, called, straightforwardly enough, structuring. This is also the stage where most people get caught, because cash is physical, cash is heavy, and cash is genuinely hard to manage at scale. There's a reason some of the biggest criminal operations in history ended up literally losing money to storage problems. Cash sitting in warehouses long enough will eventually rot, and there is no insurance claim to that. Once the cash is inside the banking system, Franklin's work isn't done, because the money still has a history that investigators can follow if they look hard enough. So now comes the second stage: layering, the process of creating so many transactions across so many accounts and countries and currencies that the original source becomes almost impossible to trace. This might look like wiring money between dozens of accounts spread across 12 countries, converting it from dollars to euros to yen and back again, generating invoices for consulting work that never happened from people who don't exist at companies that were incorporated last Tuesday in the Cayman Islands. It might involve buying real estate, acquiring art, making stock market plays, purchasing a yacht, maybe 2 yachts, because one's for business and one is apparently for vibes. The point is that each individual step in this chain might be completely legal on its own. Buying a painting is legal, converting currency is legal, sending a wire transfer is legal. What makes it criminal is where the money started and what the whole sequence is designed to accomplish, which is also why layering is so difficult to prosecute. You're not looking for one illegal act, you're looking for intent buried inside 100 legal ones. The third and final stage is called integration, and this is where the process finishes. The money has been placed into the system and spun through enough transactions that its history is deeply obscure. So now it gets reintroduced into the economy as something that looks entirely legitimate. Franklin buys a penthouse, he invests in a business, he repays a loan from a company he secretly owns, or sells a property, or cashes out some stocks. At this point, the money has a paper trail and it just leads away from anything criminal rather than toward it. What makes integration the scariest stage from an investigator's perspective is that once it's complete, even trained financial regulators will often admit it's very hard to tell the difference between clean money and money that went through this whole process. The crime is effectively finished and the money is owed. Now, the 3 stages explain the structure, but they don't explain the mechanics of how dirty money actually gets mixed with legitimate income on a day-to-day basis. That's where the front business comes in. A front business is a real operating, or at least semi-operating company that naturally handles a lot of cash, whose transactions are almost impossible to verify from the outside, and whose pricing is flexible enough that a very good day doesn't raise any obvious questions. The dirty money gets folded into the reported revenue, and the whole amount gets declared as legitimate income. The restaurant is a classic example, and there's a reason it keeps appearing in criminal history. A restaurant can claim it made $4,000 on a quiet Tuesday night, and the question of how you'd prove otherwise is genuinely difficult. Franklin's Pizza Place actually made $2,000 that night. He reports 4. That extra $2,000 is drug money, now reborn in the accounting books as marinara sauce revenue. The signs investigators look for are almost absurd when you lay them out. The food is somehow both expensive and terrible. There are almost never any visible customers, and yet the place is posting revenue numbers that would make a Michelin-starred restaurant look underperforming. One practical rule used in financial investigations is that if a restaurant's reported revenue per seat per hour is physically impossible given the number of seats in the building, someone is cooking something and it isn't the food. The car wash is probably the most iconic front business in criminal history, and there's a reason it became something close to a cultural symbol for this kind of operation. It's structurally ideal. Each wash costs anywhere from a small amount to several $100s. You can process a large number of individual transactions in a single day, and each one is typically cash-based and forgettable, and almost nobody keeps a receipt. Over-reporting your daily customer count by a significant margin is very easy to do and genuinely hard for anyone to dispute. The honest answer to whether you wash 300 cars or 800 is that nobody was counting carefully enough to know. The nail salon also works for similar reasons. It handles a high volume of cash. The pricing varies enormously depending on what services a customer chooses, and the transactions are nearly impossible to itemize after the fact. A basic service might cost $60, while a full set with gel, extensions, and detailed nail art might cost $300, and that wide range creates exactly the kind of gray zone where extra revenue can be slipped in without standing out. The vending machine empire is in some ways the most elegant version of this. If you own 50 vending machines spread across a city, you can collect cash from each of them every few days, and there's essentially no external way to audit how much any individual machine actually earned. There are no customer records, no receipts, no witnesses, just a can of Sprite and a packet of chips standing between your criminal enterprise and a perfectly clean tax return. The general principle in financial crime is that the more boring your business looks, the harder it is to investigate. And there are very few things more boring to investigate than a vending machine company. For those who prefer to operate internationally, one of the most sophisticated approaches is called trade-based money laundering. Franklin sets up an import-export company and generates an invoice for 10,000 luxury handbags being shipped from Dubai to Singapore, listed at a total value of $500,000. The container actually contains 500 knockoff bags worth about $50 in total. A company in Singapore, which Franklin also controls, pays the full invoice amount, and money that started as criminal proceeds in a Singapore account is now the documented revenue of a legitimate international trade transaction. Customs agents can't open every container. Luxury goods prices fluctuate widely enough to make specific valuations hard to challenge, and this method is estimated to move hundreds of billions of dollars globally every year, mostly in plain sight. And then there's the black market peso exchange, which is sophisticated enough that it almost commands a reluctant kind of respect. Franklin has $30 million in dirty US dollars that he can't deposit or move through normal channels. He contacts a broker who finds Colombian importers that legitimately need US dollars to purchase American goods, electronics, clothing, machinery. Those importers pay the broker's contract in Colombia using clean pesos. Franklin receives those clean pesos in Colombia. Meanwhile, the broker uses the dirty dollars sitting in the US to buy the actual goods and ships them to the Colombian importers. By the end of the transaction, the dirty dollars never left the US banking system in any unusual way, and the clean pesos were always legitimate. And the only thing that was criminal was the arrangement itself, which is also why it's so difficult to prosecute. You're essentially looking at normal international supply chains that happens to have one extra layer of coordination. In 2016, 11.5 million documents were leaked from a Panamanian law firm called Mossack Fonseca, and what they revealed was a global system for hiding wealth that was available to anyone who could afford the legal fees. Politicians, celebrities, and criminal organizations had all used layers of anonymous shell companies. Mossack Fonseca alone had created over 214,000 of these shell companies. This wasn't a back alley operation. It was a crime with a reception desk, a professional email signature, and a glass office building. What ended it was a single anonymous whistleblower who handed those documents to journalists. The lesson: no matter how sophisticated the structure, it still has to be run by human beings, and human beings sometimes develop a conscience. At the height of his operation, the Medellin cartel was generating around $60 million per day in cash. The volume of physical money became so unmanageable that cash was reportedly buried in the fields and packed into warehouse walls, and according to Escobar's son, the cartel wrote off roughly 10% of its annual earnings as money that had simply rotted off or been eaten by rats before anyone could do anything with it. 10% of $60 million a day just gone. The fundamental problem was physics. There's a maximum rate at which money could be laundered through any finite network of business and accounts, and Escobar's operation was generating cash far faster than any laundering system could realistically process it. The money itself became one of his biggest operational problems. Between 2010 and 2014, roughly $20 billion moved out of Russia through a network that didn't just exploit the financial system, it used the legal system as part of the mechanism. Russian companies would take out loans from UK-registered shell companies and then default on them. A Moldovan judge who was part of the arrangement would issue a court judgment offering the debts to be repaid through European banks. Because these were court-ordered transactions, banks were legally required to process them without question. They were laundering money, and they were using the authority of a court ruling to make the laundering mandatory. It's one of the most inventive examples in the history of financial crime, and it ran entirely through institutions that looked completely legitimate from the outside. Cryptocurrency was supposed to make money borderless and free from oversight, and for a while some people believed it would also make it untraceable. Reality turned out to be the complete opposite. The blockchain is a public ledger. Every transaction that has ever happened is recorded on it and available for anyone to look at. What cryptocurrency offers is not anonymity, but pseudonymity, which means your transactions are tied to a wallet address rather than your name. But the moment anyone links that wallet to your identity, your entire financial history becomes visible. A number of high-profile seizures have happened precisely because investigators followed blockchain records with great accuracy. NFTs seemed briefly like a solution. You could sell an NFT to a wallet you controlled for an inflated price, effectively moving money between your own accounts while generating a paper trail that looked like a sale. The problem is that the transaction history of every NFT is fully public on the blockchain, which made the circular pattern of buying and selling between controlled wallets obvious to anyone who looked at the data carefully. What actually catches people today tends to come down to a few consistent patterns. The first is lifestyle inconsistency. If your declared income is $40,000 a year, but you're driving a car that costs $400,000, that gap is going to attract attention. The second is the digital footprint that every modern financial transaction leaves behind, which investigators can follow with tools that have become significantly more sophisticated over the past decade. And the third is over-engineering. The more complex a structure is, the more components it has, and the more components it has, the more places it can unravel from. Pull one thread from a complicated scheme, and the whole thing tends to come apart. So what does all of this actually add up to? Money laundering is not suave or cinematic. It's a massive, expensive, stressful logistics problem that gets harder the more successful the underlying crime becomes. The fundamental irony is that the more money you generate illegally, the more unmanageable your illegal money problem becomes, and there is no clean exit from that cycle. The real cost of this, beyond the criminal enterprise itself, falls on ordinary people. Property prices get pushed higher by laundered investment. Savings lost when criminal banks collapse. Public resources drained by tax revenue that was hidden offshore. Understanding how the process works is a meaningful part of understanding how to stop it. And that's why forensic accountants, investigative journalists, and financial regulators exist, Because somewhere in a spreadsheet or a leaked document or an unusually busy pizza place, there's always a thread waiting to be pulled. That's a wrap. If you made it this far, you now know more about money laundering than the compliance departments at several historically notable banks. Hit like, subscribe for more of these breakdowns, stay legal, and please, if you open a pizza restaurant, actually do sell the pizza.